Hello, and welcome to part two of the chapter one lecture, where we are primarily focusing on the primary objective of financial reporting and how we determine whether or not the information that is provided to the users of the financial statement is actually useful. So, in the last video, we of course went over the objective of financial reporting. We were able to see how we develop gap, and then we started to dive into the conceptual framework. And the conceptual framework is the image that helps us sort of visualize how we get from the primary objective to gap. And last time we looked at the bridge with all of our characteristics that described information that's useful. So we had our two fundamental qualities of relevance and faithful representation. Then we had all the individual ingredients as well as the enhancing qualities, all to ensure that the information was useful. But we're not done. To ensure that general purpose financial statements are useful, we have to have some standards in terms of what is reported on the general purpose financial statements. And those standards will include the basic elements of the financial statement. So these are our real fancy definitions of things that show up on the income statement, the balance sheet, the statement of owner's equity or stockholders' equity, as well as the statement of cash flow. So let's start with assets. Now, we learned in accounting one that assets are resources that we own or control. Now, let's see if I can get my pen here because I'm going to need to underline a couple of things for you. But the formal, generally accepted accounting principle definition of an asset is a probable future economic benefit. I still get to see the word control. So we don't see the word resource, but we see the words economic benefits. But the entity controls those economic benefits. And this has happened as a result of something that happened in the past. Now, we have to call them probable future economic benefits because there are some items that, it's not an economic benefit just yet, like accounts receivable. I'm expecting that the customer is going to pay me what they owe me in the future. So, again, and that's a result of me selling something to them in the past, but I own that receivable. So if I wanted to, I could sell it, I could dispose of it, I could write it off, all of those different things. So I control it as the entity. Now let's look at liabilities. Liabilities, we had a really basic definition. The amounts owed to creditors. But the problem with that definition is it doesn't include everything. Think about unearned revenue. When it comes to unearned revenue, we don't owe any creditors. In fact, we owe our customers if we don't provide the service. So with an unearned revenue, the customer has paid us ahead of time and we have not completed the performance obligation. We haven't provided services, we haven't delivered the goods yet. So we owe that to that customer if we happen to not provide it. So let's see how the definition changes. We still see probable future. So I want you to see the consistency of that between an asset and liability, probable future. But instead of economic benefits, we're talking about economic sacrifices. So we're sacrificing our economic benefits here. And we owe someone today as a result of something that happened in the past. Now, what we owe today could involve us transferring assets if it's a loan or an accounts payable, or it could involve us providing services in terms of unearned revenue. So I really want you to break down these definitions. It's a lot of words and my lines are so squiggly, but you guys know what I mean. So when looking at liabilities, it's a bit more than amounts owed to creditors because we can't leave out our unearned revenue. For equity, we usually call that the owner's claims on the assets of the business or how much the owner of the business truly owns. but we were looking at things from the perspective of a sole proprietor. Here, we're primarily focused on corporations. So for equity, the definition is the residual interest. Now, we use the term residual because we're talking about assets minus liability. So if we were to rearrange the accounting equation, assets equal liabilities plus equity. If I put liabilities on the same side as assets, then I would have assets minus liabilities equals equity. So that's what we mean when we say residual interest. So the residual interest in the assets that remains after we deduct the liability right there for it. All right, let's look at some other elements. We have investments by owners and distributions to owners. So again, if we're talking about a sole proprietorship, then we're looking at simply the capital account. But if we're talking about a corporation, we're looking at preferred stock, common stock, contributed capital, or paid in capital in excess of par, which is sometimes called PIC in excess of par, or APIC, which is additional paid in capital. All those things are included in the investments by owners. So we're calling this increases in net assets that result from transfers from other entities. So we're talking about investors, and investors can be individuals, they can be businesses, but transfers of something of value in order to gain ownership in the company itself. A couple of keywords there. Ownership interest increases in net assets, transferring something of value. Now, distributions to owners. This could be dividends if we're talking about a corporation, or it could be withdrawals if we're talking about a sole proprietorship. But this time we're looking at decreases. Oh, I crossed it out. You guys know what I mean. Decreases in net assets. And this time we're transferring assets. We're paying something out. Or we could be providing services or incurring liabilities. And as we get to intermediate 2, we'll see more of the other examples of distributions to owners. I don't want to overwhelm you just yet. For now, just think about dividends and withdrawals. But the key word there is decreasing in net assets. Get rid of that so we can move to the next slide. Comprehensive income. This is something new that we'll talk about more when we get probably to the next unit. But sometimes there are changes in equity or net assets that happen as a result of what's on the income statement. We have revenues and expenses. Of course, you're familiar with that. That's net income. But then there are some items that bypass the income statement, and we put them in a category called comprehensive income. So if we happen to have adjustments because of foreign currency translation, or if we happen to have gains, let's say we're using the fair value method for our investments, and in using the fair value method, our investments have increased. So we need to record the difference between what the value of the investment was a year ago and what it is today. We have that increase, but I can't put it on the income statement as earned revenue because I didn't earn it. I won't earn the revenue until I actually sell it. So we call that an unrealized holding gain or loss. The fancy way of saying, hey, we're using the fair value method and we need to adjust the value of an investment up or down, and we account for it in this way. Well, those items don't show up on the income statement. They actually show up in the balance sheet in comprehensive income. So it's a change in equity from non-owner sources. So it's not like the owners are bringing money in or taking money out. We're carrying on business activities, and then that changes the value of equity. Revenues and expenses. We remember revenues and expenses. Revenues are amounts earned from providing services or delivering goods. Expenses, you got to spend money to make money. And you want to make sure that the money that you're spending is helping to generate revenues. And when they are, we categorize those amounts as expenses. Now, those are the general definitions. Let's look at the fancy definitions here in GAAP. So the revenues keyword there, inflow or enhancements of other assets. Now, this takes care of a credit sale. When I have a cash sale, I'm getting cash coming in. So there's my inflow. But if the customer promises to pay me later on, I don't have an inflow. I have an increase or an enhancement in my assets through the result of an accounts receivable. So we have to make sure we're including everything. So enhancement of an asset or an entity, or in some cases, a settlement of a liability. And I know you're looking at that, a settlement of a liability. If I have unearned revenue and I've now provided the service, I've earned the money, that's revenue, but I've also settled the liability. So this enhancement of assets is accounts receivable, settlement of liabilities is the earning of an unearned revenue, and the inflow is just a regular old cash sale. Now, how do we get this? How do we get these enhancements and these inflows? By delivering or producing goods, providing services, or other activities that are related to our central operation. So I can't say I have a law firm and I'm providing services, but now all of a sudden I want to sell meat out of the back of my truck, and any revenue I gain from selling meat out of the back of my truck gets to be included as revenue. Absolutely not. I'm in business to provide legal services, not sell meat out of the back of my truck. Now with expenses, we call those outflows or the using up of assets. Remember our prepaid expenses. As you use up an asset, you have to expense it. So supplies expense, with prepaid insurance, we had insurance expense, or the incurrences of liability. So with the outflow, I'm paying the cash right now. With the incurrence of a liability, I'm promising to pay later on. So that is an account payable. Now, why do we have these? Well, we have these outflows and this using up of assets and incurrences of liabilities. We have them in the same period because we're trying to make money. We're delivering or producing goods. We're providing a service. Or we're carrying out any other activities related to major or central operations. So I've underlined the key words that you need to look for because you can probably expect some type of question at some point in the future, whether it's on the CPA exam or some other exam, where you'll be asked to determine whether or not this statement relates to revenues, assets, liabilities. Which basic element is this statement referring to? I'm having brain freeze. Okay, here we go. Oh, still not done. Gains and losses. Gains and losses are my last two. Now, with gains and losses, I don't have to spend as much time on those. Hopefully, you remember from accounting 1 and accounting 2, when you sell property, plant, and equipment. Now, this is just one example of a gain or loss. You're selling property, plant, and equipment. Now, you're not in the business of selling off your property, plant, and equipment. You could be in the business, again, legal services, selling, producing shoes, making jewelry, bunch of different things. But at some point, you may decide that you want to sell a vehicle so that you can get a new one. Well, if you sell that vehicle for more than its book value, then you have a gain. If you sell it for less than its book value, then you have a loss. Those gains and losses need to be recorded separately from revenues and expenses because revenues and expenses relate to major central ongoing operation. Gains and losses refer to peripheral and incidental transactions because I'm in business. So if I'm in business, yeah, I have property, plant, and equipment. If I happen to retire or pay off my debt early, there could be a gain or a loss in paying off my debt early, but that is peripheral and incidental. So if it's an increase in equity, then it's a gain. If it's a decrease in equity, it's a loss. But notice we're talking about everything except for revenues or investments by owners, and for losses, expenses and distributions to the owners. All right, let's get to GAAP. Some of the basic assumptions, the principles, and the constraints. So with our assumptions, we can see our four assumptions listed here, and we're going to go through those in detail. The first one is the economic entity assumption. You probably learned it as the business entity assumption. What this means is that the business is separate from its owners in terms of it being a distinct economic entity with its own accountability, with its own bank account, with its own records. In some cases, it pays its own taxes. So it is a separate entity that can be identified with a separate economic activity. And we assume that when we are looking at general purpose financial statements. Then there is the going concern assumption. When I look at a set of general purpose financial statements, I am assuming that the business will continue, that they're not about to file for bankruptcy. Because if they are, I need to know that. If they don't tell me, I could waste my money investing in a company that's about to go under. So whenever we look at financial statements, we assume that they will keep going, which is why this is called the going concern assumption. Now, this is important because who cares about the cost principle when looking at financial statements? Now, remember, the cost principle says that we report our asset items that we purchased at what we paid for them. Well, who cares about that if I'm about to sell them off in less than a year? If I'm about to sell them off, then the fair value is more important than the historical cost, because the fair value is going to determine how much money the company is going to get for it. If a company is about to end, depreciation and amortization methods that we're using will need to be adjusted. I can't say that I expect the asset to last for 10 years when I'm going out of business next week. I have to change my depreciation method. And then the whole classified balance sheet, where I'm classifying items as current versus non-current, becomes completely irrelevant. Again, if I'm ending in a year or within the next few months. If it's a non-current item, then I'm expecting that to come due or collect it within longer than a year. But if it's current, it's within that year. If I'm ending business tomorrow, nothing is non-current. So this is why the going concern assumption is extremely important. We make that assumption. Anybody looking at financial statements makes that assumption that the business will continue. The monetary unit assumption says that when we look at general purpose financial statements, all of the activities are measured in some type of currency, whether it's the dollar, the euro, the rupee, the peso, the yen, whichever one. But all the economic activities, we're measuring them in terms of real money. The time period assumption, or the periodicity assumption, assumes that we can take the life of the company and divide it up into time periods. So we can have quarterly financial reports, we can have monthly financial reports, or we can have annual financial reports. But we can divide all the economic activity of the company up into time periods. And it definitely makes it easier to look at information, analyze information when we're looking at things in terms of specific chunks of time rather than everything clumped together over the past 10 years. Now, in looking at the assumptions, we're ready to move on to the principles. So there are four basic principles when it comes to accounting in terms of generally accepted accounting principles. We have the cost principle, also known as the measurement principle. The measurement principle is actually a more accurate name, since today companies are allowed to use either the cost method to determine the value of their assets that they record, or fair value. And we're going to talk about fair value more in the next slide, as well as the coming chapters. Then we have the revenue recognition principle, which says we can only record an amount received as revenue, or we can only record revenue when the performance obligation has been satisfied. And the performance obligation is typically satisfied after we provide the services or deliver the goods. But in some cases, there's a whole 5 step process that we have to go through to determine when we can record an amount as revenue. The expense recognition principle, also known as the matching principle, we have to report our expenses in the same period as the revenues they help to generate because you got to spend money to make money. So the expenses have to follow those revenues. And then there is the full disclosure principle. There's always a story behind the numbers. We can look at the financial statements and still not get a complete story about everything that is going on. And as an investor, there are things that I need to know that I may not be able to determine from just looking at the balance sheet. So there have to be further explanations. For example, with property, plant, and equipment, you should disclose the type of depreciation method that is used, how you're categorizing those major classes of property, plant, and equipment, what the useful lives are for each one of those categories. So you'll see all that stuff disclosed in the notes of the financial statements. The reason why it's there is because of the full disclosure principle. So let's look at each one of these in a little more detail. So in terms of the measurement principle, we can either choose historical cost or fair value. We like historical cost because it's reliable. The information is sound. I know how much I paid for the asset. When it comes to fair value, sometimes with fair value, you have to analyze the sources closely because some information is more reliable than others. But in certain situations, fair value is more useful than historical cost. When a corporation decides to invest some of their money, because you never leave cash sitting idle. As a corporation, you have cash left over, you should be taking that cash and investing it, even as an individual. But when they do that, if they're planning on selling that particular investment within 3 months, the fair value is more useful than the historical cost, especially with stock prices fluctuating up and down the way they do on a daily basis. So in that situation, fair value is more useful. So FASB has allowed companies to decide whether they want to use the fair value method or the historical cost method. Here's the deal though. When you pick one, you got to stick with it. So you can't flip flop back and forth and not use the fair value method when it's presenting you in a negative light. You have to continue to use it. And a lot more companies are using the fair value method versus historical cost. So what you see on the screen right now is a hierarchy that helps us determine which type of fair value information is more useful than another type. So it really depends on where you're getting the information from. So level 1 is the least subjective, which means we're not relying on the opinion of someone else. It has a greater degree of usefulness, and I can rely on that a little bit better than level 3. In some situations, I do have to use level 3 if that's all that I have, but I like level 1 information better than level 3. So an example of level 1 information, I can actually observe it, meaning I can look up the stock price. I remember what was it, 2 years ago, I needed to do taxes for one of my clients, and they sold one of their stocks. And when I was looking at the tax report, of course, the company didn't tell me how much they paid for that particular stock, but they had the date of the stock purchase. So all I had to do was go to Google and look at the Wall Street Journal, and I could pull up that particular company and say, hey, what was this price of this stock on this date? And that was an example of an observable input. I could quickly get that information. And that was important because I think that stock was purchased like back in 1988. It was a long time ago. But level 1 is the least subjective. With level 2, I don't have quoted prices, but I have similar assets or liabilities available in an active market. So if I'm looking at the debt of a company and that particular company, they have a certain type of debt instrument that is similar to a company that has a debt instrument that is traded on a public stock exchange. If that's all I have, I can use that. So if I'm looking at the company and they have this debt and their credit rating is, I don't know, C, which is low, or double B, then I can look at something similar, or the ratings and the percentages that are used for other double B or C bonds. For level three, I'm relying solely on the company's data. We're using the best information available, but again, this is the most subjective because it requires a lot of judgment. Now, if I don't have anything from level one or level two, then I got to take level three. But if I have something for level one, then I should use it over the level three information. Now, for revenue recognition and expense recognition, we already talked about those. But I did want to show you the 5-step process to determine when we can recognize an amount as revenue. Now, recognize is just a fancy way of saying recording. When do we make the journal entry for revenue? Well, there is a 5-step process, and all 5 of these steps have to be complete before we can recognize or record an amount as revenue. So in step 1, we have to identify the contract with the customer. Now, the example that you can see on the screen and the example that's used in your book is the example of Boeing, and they sell planes, and they're trying to sell planes to Delta. I like to use the example of coffee. You're walking into a coffee shop and you approach the counter. Just you approaching the counter, just based on business norms, that means that you probably want to buy something. So you approaching the counter and asking the barista for a cup of coffee is a contract. So right there, the contract has been identified. Now, for Boeing and Delta, they have a formal agreement. So that contract doesn't have to be in writing. It could be based on regular business norms. So after the contract has been identified, we move on to step 2, where we identify the separate performance obligations. So in this case, Boeing only wants one plane. So there's one performance obligation. If they wanted 2 jets, then there would be 2 separate performance obligations. For me, if I am purchasing my coffee and let's say I want a muffin, I don't even like coffee, I like hot chocolate, but we'll use coffee because more people like coffee than hot chocolate. But if I want to buy a muffin as well, then I have 2 separate performance obligations, one for the coffee, one for the muffin. They have to be accounted for separately. So I need to know if there are separate performance obligations before I can move on to the next step. Because in step 3, I need to determine the transaction price. Now, in the contract, pretty straightforward. The transaction price should be there, 100 million. When I'm buying my coffee, I should be able to look. There should be a sign somewhere that tells me the cup of coffee is $2 or $3 or whatever it is. But in addition, because I'm buying that muffin, I also need the transaction price of the muffin. Now, in step 4, this is where we allocate the transaction price to the separate performance obligation. Now, for me, it's pretty straightforward because I can see the price of the muffin, I can see the price of the coffee. But what if on that particular day they were doing a deal where I could get a cup of coffee and a muffin for $5? In that case, if I am the accountant for the coffee company, I have to allocate what portion of that $5 belongs to the muffin, what portion of that revenue of that $5 belongs to the coffee. Why? I got to keep track of each one separately so I can know which product is making me the most money, or do I need to make my improvements. So in step 4, we need to allocate the transaction price to the separate performance obligations. If you only have one performance obligation, you're good to go. Now, in step 5 says we can finally record the revenue when each performance obligation is satisfied. So when Boeing delivers that plane, all done. We can record the 100 as Boeing, we can record the 100 million as revenue. For the coffee shop, when I walk in there and I get my muffin, I'm not done because I still ordered some coffee. So the performance obligation is not satisfied until I get both items. So once it's satisfied by either delivering the goods, providing the service, then the revenue can be recorded. Now, this is the examples I gave you pretty straightforward. When we get to intermediate two, there's a whole chapter dedicated to revenue recognition. Because yes, it seems straightforward, but we could throw a bunch of wrinkles in there. We're going to have tons of fun with that later on. For expense recognition, this sort of aligns with what you learned in accounting two, the second half of accounting two, or cost accounting. If you've already taken cost accounting, then you did a lot of manufacturing accounting. You know that you have product costs versus period costs when you are a manufacturing company. Product costs are said to be inventoriable, which means we record them as inventory first, and then when they are sold, we record them as cost of goods sold, the expense. So our product costs or our inventoriable costs are materials, labor, overhead. Three basic costs associated with making a product. The issue is that I can't immediately record direct materials as an expense, not until after the product is finished and then it's sold. Because remember, these costs are issued into production and they go into work in process. And then once they're finished, they go into finished goods. And finally, when we sell them, we take them out of finished goods and we put them in the cost of goods sold expense item. So we're making sure we're matching our revenues with our expenses. Because with some products, like if I'm aging cheese or aging wine, when I purchase the direct materials may be a long time away from when I finally sell the goods. So I want to make sure that I'm matching revenues with expenses in the same period. Now, with period costs, these costs are non-inventoriable and they are expensed as they happen. So when you see incurred, don't panic. It just means as it happens. These are costs associated with running my business, not necessarily making my product. So paying my accounting people, paying my HR people, marketing, advertising, all of those things, those are expense as they happen. They don't go into inventory first because, again, they're associated with helping me generate revenue this period. And here's a full disclosure principle. Because of this, a complete set of financial statements includes notes and it includes supplementary information as well as the financial statement. And finally, the cost constraint. We always have to do a cost benefit analysis because the benefits have to outweigh the cost. So with all the reporting that we do, if it's too costly to present the information, then we do the best we can with what we have. We're always bound by the cost constraint. So here is a summary of the conceptual framework. And it doesn't matter how it looks, whether it looks like this or whether it looks like this one. The only difference between this chart and this chart right here, it's flipped upside down. I like to have the objective at the bottom. And I like to have the tip of the iceberg that's visible. All this other stuff is underwater as GAAP, the assumptions, the principles, and the constraints. All held up by my qualitative characteristics and my elements, as well as the objective. Others like to have the objective first because that's the most important thing. It's driving everything else. But I like the flip version only because you're used to seeing this, and now I get to tell you what's underneath it, how we came up with this. But keep in mind that all of this is just held up by the fact that we're trying to provide useful information. There's that key word, useful information. I talked about the cost constraint already. Finally, let's look at the major challenges in the financial and reporting environment. So we have quite a few challenges. GAAP, generally accepted accounting principles, because it's created by FASB and FASB is under the SEC, which was created by the government. Oh, this is just political action. Of course, the people with the most amount of money lobby the most and they can influence what the rules are. So sometimes when we're looking at these rules, they may not make logical sense. They may not be based on empirical findings, which means we've observed data input and we have crunched some numbers and we've done statistical analysis. Gap isn't the result of all that. It's the result of the political environment. And let me show you the political environment because it includes all these people. It includes us, individuals that are in college learning the information and those teaching the information. It includes us from the standpoint that we're working there, whether we're working in accounting firms, we're members of the profession, if we're working for private businesses, working in government, doing audits, investors, the business entities themselves, the AICPA or the American Institute of Certified Public Accountants, all of those industry associations in every single state has a board of accountancy and they have their own organization. So the Delaware Society of CPAs or the Maryland Society of CPAs, all of those people are influencing FASB, which in turn influences generally accepted accounting principles. So there are major challenges in financial reporting, not just the political environment, but also the expectations gap. So you can see my meme here. It's not mine. I borrowed it from somewhere else. You can see where I got it from. But there's always a huge difference between what we do and what the public thinks we should do. And sometimes the public thinks we should find every single error that exists. But we're bound by materiality. I can't find every single error that exists. And sometimes, if the company has been dishonest with me as the auditor, I may not find fraud. Now, I have a responsibility, but I may not find immaterial fraud. That may bypass me. I have a responsibility to find material fraud. But that gap, that expectations gap, is really hard to close because of what the public thinks we should be able to do. Back in 2002, there were tons of scandals that changed the way the accounting profession regulated itself. We used to be self-regulated. We made up our own rules, we enforced our own rules, and that authority was taken away from us through the Sarbanes-Oxley Act and the creation of the Public Company Accounting Oversight Board. So this made it so we don't just have accountants sitting there telling us what the rules should be. We have people from other industries sitting on this board, and they have some say in what the rules are and whether or not the rules are being totally enforced. Other challenges that we'll run into: non-financial measurements. We're looking at financial reports, but it doesn't tell us the entire picture. If a company has an incredible brand that people recognize and they have brand loyalty, we can't put a number on that and put that on the financial statement. If they have an amazing, innovative workforce that comes up with these creative ideas all the time, again, we can't assign a dollar value to that and put those people on the balance sheet. We don't own people, so we can't put that on the balance sheet. So sometimes the financial reports don't tell the entire story. So we do have to look at other places, including the sustainability efforts that a lot of people place a lot of weight on. But as an investor, you have to look at other places. And sometimes when we look at an annual report, some of those items are addressed, but it's not in the financial reports. So that becomes an issue. In looking at our financial reports, we're always looking backwards and we're providing information on what happened in the past. But investors need information about the future. So when we look at the entire annual report, you'll see forward-looking information presented. But again, it's not in the financial reports in terms of the balance sheet, the income statement, the notes to the financial statement. Other items, we have soft assets. We're primarily focused on hard assets like property, plant, and equipment, inventory, but sometimes our intangibles, we don't really focus on those in accounting. And again, not assigning a number to those things and showing their value, because sometimes it's difficult to value. We may not even be able to value it until it is time for those items to be sold. Timeliness, it's hard to get real time information when the financial statements are actually produced. Usually, again, we're backwards looking, and the financial statements are issued a couple of months after the end of the fiscal year because we need time to prepare it and audit them. And understandability. Oh my goodness, with all the information that's out there and all of the new products, the NFTs, cryptocurrency, all this new stuff on the horizon, the understandability of financial reports is definitely becoming a concern because those financial statements are getting extremely complex, primarily because the technology is complex. So these are reporting issues that aren't going away anytime soon. And the final major challenge in financial reporting, ethics. Ethics is always an issue, not just in financial reporting. I love to comb through the Wall Street Journal just to see which companies are having ethical issues now. Who reported something and said something was revenue when it really wasn't now. It's always happening. And that's because doing the right thing is not always clear. There is some interpretation in some of the rules and principles. GAAP doesn't always provide us a clear answer, and sometimes hindsight is 2020. So that's always a major challenge. Now, the international standards, you can go back at the end of each chapter and kind of look at the international standards. There are some similarities and some differences. GAAP, again, comes from FASB and the SEC, but the international standards come from the International Accounting Standards Board, and it's regulated by the IOSCO, that commission, the Treadway Commission. So we have similar governing bodies. FASB looks the same with that foundation, and the Advisory Council, that looks the same as the International Accounting Standards Board. We've been working together for convergence, but it hasn't happened. The international standards, they've completed their conceptual framework, and FASB hasn't. So what I showed you is still in the works in terms of the conceptual framework, but useful information still there. Providing useful information is still the primary objective. Biggest difference between the international standards and GAAP. GAAP is more rules-based. It's more specific. It's really detailed. Whereas the international standards are more concerned about the spirit of the rule versus the rule itself. So it's more principles-based. We're looking at principles, not just specific rules. You'll see a lot more fair value when it comes to the international standards than GAAP. But we're moving towards using more international standards. There's some information on stewardship and that framework. You can, again, go through that on your own time. These are not items that you will be tested on because I don't want to turn this into an international accounting course. I really want to focus on GAAP, but I do want you to recognize those differences. All right, that is it for chapter 1. I so appreciate your time and attention in watching this video, and I hope you have a wonderful day.